Welcome to the deep dive. Today we're pulling back the curtain on something really fundamental to the financial system. It's the plumbing, really. Often invisible stuff. The U.S. repo and securities lending markets. You probably don't hear about them, headlining the news every day, but honestly, these are the gears that make the financial world actually turn. Our mission for you today is to dig into some great sources. We've got a really in-depth guide from the New York Fed, a presentation from the International Capital Market Association, and we're going to pull out the most important nuggets, the key insights, to help you understand what these markets are, how they function, the hidden risks, and really why they matter for, the broader financial picture.
Yeah, and what's fascinating, I think, is that they operate so quietly behind the scenes, mostly, but they enable almost everything, from complex investment strategies right down to just the daily settlement of trades. Getting a handle on them is, well, it's pretty key to understanding financial stability overall. So, yeah, let's unpack this for you.
All right, let's start right there then. Fundamentals. If these are the pipes, what exactly are repurchase agreements, repos, and securities lending? How do they relate
Yeah.
or differ?
Okay, so the simplest way to think about a repo is it's basically like a cash loan, but the structure is different. It's structured as a simultaneous sale and repurchase of securities. You sell a security today, you promise to buy it back later, say tomorrow, at a specific, slightly higher price.
Okay.
And that difference in price, that's basically the interest rate implied in the deal.
Got it. And securities lending.
Securities lending is, well, maybe a bit more straightforward. It's just a short-term loan of stocks or bonds, usually for a fee. And it's also typically secured, usually by cash or maybe other securities as collateral.
Okay, so if you're a firm, why are you doing this? I mean, what's the real-world application? How are these actually used day to day?
Great question. It really gets to why they're so important. So firms use repos primarily to borrow cash. They have securities, they use them as collateral to get funding. Securities lending, especially the type collateralized by cash, that's often about getting your hands on a specific stock or bond that you need for some reason.
Like for short selling?
Exactly, that's a big one. Or maybe to hedge an existing position or facilitate market making, making sure trades can happen smoothly. And these aren't small markets. The scale is huge. Daily repo volumes, even post-crisis, we're talking around $5 trillion.
$5 trillion daily.
Yeah, it's enormous. It dwarfs a lot of the unsecured cash markets, but it happens sort of under the radar, keeping the whole engine running.
Wow. Okay, so it sounds like securities dealers must be absolutely central to all this activity. Tell us a bit more about their role.
Oh, absolutely. They are the ultimate go-betweens, the intermediaries. Think of them like a hub. They stand between those who have cash and want to lend it out safely against securities.
Like pension funds, maybe?
Yeah, pension funds, money market funds looking for a bit of yield. And on the other side, those who need that cash, need that funding. That could be hedge funds or mortgage REITs. MREITs, they're often called.
Okay.
And dealers also connect the dots for securities lending. So they find those wanting to lend out specific securities to earn a fee and connect them with those needing to borrow them, like those short sellers we mentioned. Their whole game is basically raise cash cheaply, lend it out at a higher rate, and manage the collateral efficiently. Get it, pledge it, move it around.
Makes sense. So dealers are the hub.
Yeah.
But you mentioned the market isn't just one big thing. There are different types, right? Bilateral, triparty, GCF Repo. Can you break down those distinctions? Why do they matter?
Yeah, absolutely. The U.S. repo market really splits into two main segments based on how the trades settle. You've got bilateral repo and you've got triparty repo. So bilateral repo is just that, bilateral. Two parties deal directly. They agree on everything. The amount, the rate, the specific securities usually identified by their CUSIP number, like a serial code, the haircut, which is that buffer between the loan value and collateral value, and the maturity. Now, the key thing here is the cash investor gets full control of that specific collateral.
Okay, so they actually hold it.
Exactly, which means the collateral provider faces a risk if the investor fails to return it on the closing leg. Dealers often like bilateral repo if they need a specific security because they can take it and immediately repledge it somewhere else. Plus, it tends to settle earlier in the day.
Okay, that's bilateral. What about triparty?
Triparty repo involves a third party. A clearing bank, like BNY Mellon or JP Morgan, acts as an intermediary for the back office stuff. They handle the settlement on their books, make sure the collateral meets the agreement's terms, that kind of thing. A really crucial feature is that securities used in triparty repo generally can't be repledged outside that triparty system by the cash provider.
So that offers some protection.
It does, yeah. Protection for the collateral provider against that kind of settlement failure risk. Triparty usually involves general collateral, or GC, meaning not a specific bond, but any security within a defined asset class, like treasuries or agency mortgage-backed securities. Dealers use triparty a lot for just general short-term funding needs, especially for securities they might pick up later in the trading day.
Okay. And then there was GCF Repo.
Right. GCF Repo stands for General Collateral Finance Repo. It's a specific service actually introduced by FICC, that's the Fixed Income Clearing Corporation, back in '98. But interestingly, it actually settles on the triparty platform.
Oh, okay.
Yeah, FICC acts as a central counterparty, or CCP. This allows dealers to trade cash and general collateral anonymously through interdealer brokers. A really unique feature is it often has a zero haircut. FICC manages the risk differently, through eligibility rules and contributions to a clearing fund.
Zero haircut. Interesting.
Yeah, it's specifically for GC, like treasuries and agency MBS. And the way it settles means dealers can easily take collateral they received in GCF Repo and pledge it right back out into the triparty system. It links things up.
That is a complex system. A lot of moving parts, as you said. It sounds like a sophisticated balancing act for these dealers. What kind of risks are actually embedded in holding these repo positions? I saw terms like interest rate risk and specials risk.
That's exactly right. Those are the two main categories of risk that repo traders are constantly juggling. First, you've got interest rate risk. This relates to those general collateral, or GC rates we mentioned. You can almost think of GC itself as its own kind of money market instrument with its own yield curve. And that curve moves based on, overall demand for secured borrowing, the supply from new bond issues, maybe central bank actions, things like that.
Okay, so standard interest rate exposure, basically. What about specials? That sounds trickier.
It is definitely trickier. Specials risk is about specific bonds. A particular bond becomes special when it's really in high demand, maybe lots of people want to short it, or it's needed to deliver against a futures contract. So the cash investor wants that specific bond, not just any GC.
They'll accept a lower return on their cash just to get that bond.
Precisely. The repo rate on that specific bond goes below the general collateral rate. It trades special. And the drivers here are different. It's about relative value trades, hedge fund short positions, the actual supply of that bond, how much dealers are holding. It's much more idiosyncratic.
Okay, so how do firms actually measure these risks and then, try to manage them? Sounds like it needs to be pretty precise.
Yeah, they have tools. One common measure is DV01, sometimes called BPV or delta. It basically quantifies your sensitivity. It tells you the profit or loss you'd expect from a tiny 1 basis point move in interest rates. A basis point is just 0.01%.
Right.
So, for example, if you're borrowing, say, $100 million against 3-month GC, that's called reversing, and your DV01 might be positive 2,500. Yeah. That means if GC rates fall by just 1 basis point, you make 2,500 euro. It pins down your exposure. But for a whole portfolio, especially a matched book where you have offsetting trades, a more comprehensive measure is needed. That's where value at risk, or VaR, comes in. VaR estimates the worst loss you might expect over a certain period, like a day, with a certain confidence level, maybe 95% under sort of normal market conditions.
Why VaR?
Because it captures the correlations, how different positions might move together or offset each other. It gives a portfolio-level view of the risk.
Okay, that makes sense. So how do you hedge this stuff? It sounds like hedging specials risk in particular could be really challenging.
You hit the nail on the head. Hedging the general interest rate risk. That's more straightforward. You can use instruments like overnight index swaps, OIS, or maybe Euribor futures if you're in Europe, or even just doing offsetting repo trades.
So if you borrow GC, you could maybe lend GC for a similar term.
Or use a swap, yeah. Like if a firm bids on 250 million of 6-month Euro GC, they might simultaneously pay on a 6-month OIS for the same amount to neutralize that rate risk.
But specials?
Specials risk is a different beast altogether. It's notoriously difficult to hedge effectively. Specials rates can be incredibly volatile, unpredictable. They can gap suddenly. In fact, theoretically, being short a special mate, meaning you've lent it out on repo and hope the rate stays low, is kind of like being short a call option. Meaning your potential profit is limited and known up front, but your potential loss, if that bond suddenly becomes really special, really in demand, could be, well, theoretically unlimited.
Wow. Okay.
Yeah, that asymmetry makes traders extremely cautious about taking large positions in specials. The risk management is intense.
This feels like a good point to talk about vulnerabilities. Because the 2007-09 crisis, it really threw a harsh spotlight on this part of the market, didn't it?
Yeah.
What exactly went wrong and what's been done since then to try and fix things?
Oh, absolutely. The crisis exposed a massive overdependence on this kind of short-term wholesale funding. And also, some real problems with the market's plumbing, the infrastructure itself. For example, in the triparty repo market, there's this huge reliance on the clearing banks extending massive amounts of credit during the day, intraday credit, to facilitate settlements.
And that was risky.
Hugely risky. If a major dealer suddenly failed midday, the clearing bank could be left holding the bag, facing enormous losses. That was a major systemic vulnerability. Since then, there have been substantial reforms led by the Fed and industry groups to drastically reduce that reliance on intraday credit. It's much, much lower now.
Okay, that's one thing. What else?
Regulators also came in with much tougher rules generally, aimed at forcing banks to reduce leverage and cut back on their reliance on unstable, short-term funding like repo. Think about things like changes to how deposit insurance is assessed, the big Basel III capital and leverage requirements, including the enhanced supplemental leverage ratio, or ESLR, for the biggest banks.
And did that work? Did banks actually reduce their repo borrowing?
It seems so, yes. Dealers significantly cut their repo financing as a percentage of their total liabilities, from something like 32% pre-crisis down to around 13% by early 2015. They also started using longer-term repo, extending the tenor, making it a bit more stable.
But you mentioned foreign banks earlier.
Right, that's an important caveat. While U.S. banks deleveraged, the U.S. branches of foreign banks actually increased their reliance on wholesale funding, including repo and Fed funds, by over 20% since 2008. There are new regulations coming in, like Regulation YY, that will require large foreign banks to set up U.S. intermediate holding companies, subjecting them to similar stricter standards as U.S. banks. So that's still evolving.
I remember hearing about fire sales during the crisis. That sounds terrifying. How do repo markets contribute to that kind of risk, and what's being done?
Fire sales are a huge concern, yeah. The risk is that during a panic, cash lenders, the ones providing the funding in repo, just pull back. They get nervous about a dealer's creditworthiness, even if the dealer isn't actually broke, and they just stop rolling over the repos, stop lending.
Forcing the dealer to sell assets quickly.
Exactly, forcing them to dump securities onto the market at potentially fire sale prices just to raise cash. And that doesn't just hurt the dealer, it can depress market prices across the board, causing losses for others holding similar assets, potentially triggering wider panic. It transmits risk.
So how do you stop that?
Well, one really contentious area is the safe harbor provisions in U.S. bankruptcy law. These basically let repo creditors jump the queue in a bankruptcy. If their counterparty fails, they can immediately seize and liquidate the collateral outside the normal, orderly bankruptcy process.
That sounds good for the creditor.
It is, but some argue it creates bad incentives. It might encourage too much reliance on this very short-term funding, knowing you can grab the collateral quickly if things go bad. And it could make those fire sales worse in a crisis. There are proposals to change this, maybe limit the safe harbor for repos backed by riskier assets, not government bonds.
But that's debated.
Highly debated. The counter-argument is that weakening safe harbors could make repo more expensive, shrink the market, or just push the activity into less regulated areas, maybe offshore. It's a tricky balance.
Okay. And shifting slightly, what about securities lending? Were there different vulnerabilities there during the crisis?
Yeah, the story was a bit different for securities lending. The really big losses weren't generally from borrowers failing to return the stocks or bonds they borrowed. That part actually held up reasonably well.
So what was the problem?
The problem was primarily with cash collateral reinvestment.
So the cash received as collateral.
Exactly. Agent lenders would take cash as collateral for lending out securities, and then they had to reinvest that cash somewhere to earn a return to share with the security owner. During the crisis, some firms, famously AIG, took way too much risk in how they reinvested that cash. They put it into things like mortgage-backed securities that collapsed in value.
Leading to massive losses.
Billions in losses, yeah. It was about mismanagement of the cash collateral pool. Another potential issue is indemnification. That's where the agent lender guarantees the security owner against the risk of the borrower defaulting.
So the agent takes the hit if the borrower fails.
Essentially, yes. Now, historically, actual losses from borrower defaults that trigger these indemnities have been very small. But it's still a contingent liability for the agent lender, mostly large banks. Post-crisis rules are making bank-affiliated agents hold more capital against these potential risks.
Which might affect the market.
It might, yeah. It could make it more expensive for banks to offer indemnification, potentially pushing more of the securities lending business towards independent, non-bank agents who aren't subject to the same capital rules.
This is all incredibly detailed. It really highlights the complexity, but it also sounds like getting a complete, clear view of everything happening in these markets is, well, difficult. What are the main challenges right now with data and transparency?
You're absolutely right. Data transparency is still a major, major hurdle. While we actually have pretty good detailed data on the triparty repo market and also the GCF repo segment, thanks to FICC,
The bilateral market is fuzzier.
much fuzzier. And securities lending activity is even more opaque, critically so. For instance, the data the Fed collects from primary dealers, the FR 2004 data, it gives totals, but it lacks really crucial details. Things like the haircuts being used, the specific rates on different types of collateral, and importantly, who the counterparties are. You can't easily see the network of exposures.
And bank reporting doesn't fill the gap.
Not really. Bank reports tend to be aggregated snapshots taken only at the end of each quarter, and that data can be skewed by window dressing firms tidying up their balance sheets just for the reporting date, which might not reflect their typical activity levels.
It's genuinely hard to see the full picture of risk building up.
It really is. And for securities lending, it's even tougher. There's basically no systematic mandatory data collection by regulators specifically targeting that market. We have to rely on voluntary surveys from industry groups like the Risk Management Association or data from private vendors.
Which are incomplete.
Yeah, they're useful but incomplete. They often miss key details like counterparty information or specifics on how that cash collateral is being reinvested, the very thing that caused problems in the crisis. This lack of comprehensive, standardized data makes it incredibly difficult to properly map the interconnections across the financial system and spot potential vulnerabilities before they become critical.
What's needed then?
A big piece missing is a universal standard for identifying firms, like a global legal entity identifier, or LEI. If everyone used LEIs consistently in reporting repo and securities lending trades, regulators could actually connect the dots much more effectively and get a real-time view of market-wide exposures and concentrations. That would be a huge step forward.
Wow. Okay, it's really clear that while these markets might operate in the background, their impact on financial stability is just immense. Understanding all these nuances, the different transaction types, the risks, the regulatory efforts, it really does give you a much deeper appreciation for how the whole financial world hangs together.
It really does. And, knowledge is great, but it's most valuable when you can understand it and see how it connects. Knowing about these underlying mechanisms, this plumbing, helps you appreciate just how interconnected everything is, and also appreciate the ongoing work, the constant effort to try and make the system more resilient.
Absolutely. So maybe here's a final thought for you, our listeners, to mull over after this deep dive. We've talked about increased regulation and transparency, pushing some activity around, maybe shrinking parts of the market or shifting it. So the question is, if that happens, if segments of repo and securities lending move outside traditional banking, maybe into less visible corners, what might be the unintended consequences? Could we see new issues arise around market liquidity? Or could new, harder to track risks actually be emerging elsewhere as a result of trying to fix the old ones? Something to think about.